Now, it may take some more than a spoonful of the president's mortgage measures for the housing medicine to go down. Try a 30% decline in home prices. That's according to the author of Crash Proof, Peter Schiff. He spelled it out in an op-ed in today's New York Times, which was called Frozen Rates, Falling Prices. Peter Schiff joins us now. Peter, welcome to the program.
Thanks for having me, Stuart.
Look, I know you think that America is basically going bankrupt and that we've spent our way to penury, but a 30% decline in home prices takes us back to the Great Depression. Make your case.
Well, remember, we had an unprecedented run-up in home prices. In many parts of the country, prices doubled and tripled. You know, where you're putting in these bids in Florida, 30% off bubble prices is no bargain. When I'm talking about 30% down, I'm talking about nationwide. So in markets like Florida, where you're trying to buy, the declines are going to be much greater than that, 50% or more. If you want to put in a low-ball bid, try 70% off.
Peter, you're talking about a return to the days of the Great Depression.
Well, no,
Are you forecasting a depression
No,
here?
I'm talking about real estate prices going back to where they were in 1999-2000. I mean, that's not the Great Depression prices. Remember, prices got bid up to these crazy levels based on lax lending standards that no longer exist. It was only because people could buy homes without using any of their own money, with no down payments, with teaser rates, with negative AM, interest only. There was a speculative mania that drove real estate prices to crazy levels, and they're still not back to normal, let alone inexpensive.
If we now reform the lending rules, like no prepayment penalties, for example, sue your lender if you can't pay your mortgage back, prove your income, those kind of reforms, if we do that, I put it to you that poor people, marginal people, are essentially aced out of the housing market for years to come.
Well, they're going to be aced out until the prices collapse, which they will do, and until they can save up a down payment. But one of the main reasons prices have to come down is because nobody can afford today's prices. They're only affordable, and I put that in quotes, because of the crazy financing terms that don't exist anymore because the lenders are getting wise because they've lost so much money.
So you discount completely the idea that this winter may be a washout. The desperation of sellers, down the prices go, but some buyers return in the spring. That's not going to happen, you say.
We are nowhere near a washout. You know, the woman that was talking about Beverly Hills real estate, if you look at California real estate, existing home prices are barely down, or they're maybe even slightly positive over the last year. I mean, new homes are down quite a bit, but people have not made the mental adjustments to the fact that their homes are not worth what they think they are. We have a long way to go down in those markets. I mean, the price declines are going to be enormous. I mean, maybe we'll start to see closer to a bottom in 2009, 2010, but the prices have to go a long way down before people can buy them for a reasonable price.
Let me get this right. You're saying that prices nationwide have to go down 30%, and in some of the previously hot, I'm going to call them bubble markets, they're going to go down 70% before we reach a rational base. Is that your point of view?
In foreclosure, certainly. I mean, maybe under normal arm's-length transactions, you might only see 50% declines, but in certain cases where developers go bust or there's lots of auctions, you can see prices down by 70% or more.
And you don't think that people with money, people with capital, people able to get loans, they're not going to come in at 30% down?
No, they just had an auction. I read about it in the newspaper last week. They auctioned off about 1,200 homes in foreclosure in Northern California, and less than 1% of the homes even sold, and they sold at 40 to 50% below the mortgage balances, but 99% of them went unbought. Nobody would even buy them at 50% off, and we're nowhere near the bottom yet.
Foreign buyers, Europeans on the East Coast, Canadians in the northern states, Asians on the West Coast, Latin Americans in the southern part of the country?
You can certainly make an argument that some of the choice vacation properties on the coasts of Florida and Hawaii and California could be attractive for vacation homes for foreigners. But I think in the near term, in the next year, foreigners are more likely to want to unload their U.S. property than buy more because they're going to realize that prices are going to fall a lot more and the dollar is going to take another huge hit in 2008. And so that's going to impose even greater losses on foreigners who want to buy our real estate.
All right, Peter Schiff, you made your point. We heard it. Thank you very much.
Sure.
Oil prices bubbling back up to just under $96 a barrel on worries that Turkish attacks on Kurdish areas of northern Iraq could lead to supply disruptions. There are also concerns that oil inventory numbers out tomorrow will show a sixth straight week of dropping crude stockpiles. Those higher oil prices mean higher fuel costs for the airlines. The result, an across-the-board downturn. The Amex airline index down 2%, with all 14 of the index's components showing losses. Mega shipper FedEx waited until Santa completed his rounds before announcing a 5.5% rate increase for its freight business. Rates will also go up next month for the packages most consumers get from either FedEx Express or FedEx Ground, under a previously announced increase. Investor Warren Buffett giving a big holiday present to the Pritzker family, paying $4.5 billion for 60% of Marmon Holdings, the industrial conglomerate making things like plumbing pipes and railroad tank cars. It is the biggest acquisition for Buffett's Berkshire Hathaway outside of the insurance industry. So, if Buffett's buying a company that needs a healthy economy to thrive, is he saying all this talk of a recession is overdone? Not a bad question, and I'm joined by our panel for the answers. Tracy Burns, Fox Business reporter, Jonathan Honing of Capitalist Pig Asset Management, John Layfield of Northeast Securities, and Peter Schiff, president of Euro Pacific Capital. John Layfield, to you first. What do you make of Buffett's investment?
I think Mr. Buffett understands the consumer very well. You look at his investment in Coca-Cola. I think this acquisition right now of Marmon has as much to do with the railroads, the rail tank car division, as it does anything else. He has about an 18% stake in Burlington Northern, B&I, which I also own. He's going to increase that to about 25%. I think he's making a bet on the consumer going forward. Obviously, he's sitting on a ton of cash. There's been talk that he's made overtures about some of this distressed debt. We'll wait and see what that is, but I think Buffett is making a concerted effort on the U.S. consumer here, as is Carl Icahn on transports when he stepped into CSX.
All right. Jonathan Honing, is that what Warren Buffett is telling you about this investment?
Well, I don't think Buffett thinks about the consumer looking out 6 months or 12 months or even 18 months, Stuart. I mean, Buffett is the quintessential long-term investment. And, you know, he really acts more like a private equity company these days. I mean, he likes to buy family-owned businesses that are not publicly traded and hold on to them for decades and decades. I mean, Bradshaw, you mentioned Coca-Cola. He's held that stock for literally decades. So I think Buffett is looking at this truly for the next 20, 30, 40 years, and we could very easily be getting some economic slowdown in the next 20 or 30 months.
All right, Tracy, he's got, what I'm told, like $40 billion to spend, and he chooses to spend a very small part of it on an industrial company which depends upon economic expansion for success. What do you think he's telling us?
Well, that's the thing. $43 billion on the balance sheet could go anywhere. Could really buy Citibank himself if he wanted to. But that's not where he is. He typically makes these very safe investments. This is a very safe investment. You know, he was in China. He did it. He slowly was pulling out of PetroChina, his investment there. So I think he's staying home. To Jonathan's point, he's very long-term. But I don't know if he's thinking 30, 40 years. I think he's definitely thinking at least a year or two out. So I don't think he's expecting to benefit from this within the next 6 months.
All right, Peter Schiff, you've been telling us that the American economy is really headed south, big time. Do you think that Mr. Buffett is making a mistake with this industrial investment?
Well, I don't know. I mean, I think Buffett is way too smart to be betting on the American consumer. So when I look at this company and see their manufacturing, they're involved in mining and agriculture, they have overseas operations, maybe Buffett is looking more towards their export potential.
But wait a minute, Peter. Supposing he is looking at the American consumer and likes what he sees.
Well, I think if he was
thinking.
I think if he was looking at the American consumer, he would be involved in more pure plays on the U.S. consumer. I mean, he would be looking at the retailers that are beaten down, or maybe some of the home builders.
You could argue that this is a pure play on the American economy.
I don't think that's what it is. I think if you look at some of the basic business they're into, if Buffett is making the right bet, I know ultimately the U.S. economy is going to have to return to a manufacturing, savings, and production economy, and maybe this is what he's looking at long term. He's looking at tapping into the growing purchasing power of foreigners, not the diminishing purchasing power of Americans.
But, Peter, this holding company has about 125 different companies, and the majority of them rely on the U.S. consumer. So that, I mean, Buffett's making a statement by buying in 60% into this company.
I don't know. I mean, you know, if he wanted to make a pure bet on the U.S. consumer, there are better ways to do that. But I'm going to give Buffett a little more credit than that. I don't think that he's that foolish. But who knows?
All right, John Layfield, are we going to go back to being an industrial manufacturing economy that saves a lot?
I think we're rapidly becoming Europe's China right now. You look at a lot of our exports right now, they have tripled over the past year because of the low dollar. I think you're going to see that going forward.
Our exports haven't tripled?
You look at our exports over the past year, absolutely.
They haven't tripled.
I'm talking about the fact that our exports are up huge right now. I don't know how you can dispute that. Our exports are up massively right now.
Well, our trade deficit almost hit a record last month.
Our trade deficit has more to do with oil prices than it has to do. You have $100 oil, we're always going to have a trade deficit. And the trade deficit, I would argue, is pretty irrelevant right now.
Sure, we have to pay for all that oil. You just can't say we're going to run a deficit, indefinitely. If we're going to import oil, we got to export something to pay for it.
All right, Jonathan Honig, I want to break in and give you the last word on this, Jonathan.
Well, no one ever wants to bet against Buffett, and I don't think I would. But, Stuart, honestly, if he was super bullish on the American economy, to Tracy's point, maybe he'd be putting a little more of that $40 billion to work. He's still got a lot of cash on the sidelines. So I think before you could say that Warren Buffett is super bullish on America, you'd see more of that money invested in the market as opposed to sitting on the sidelines in a money market account.
All right, panelists, one and all, thank you very much indeed. Barron Hilton has over $2 billion to give away. Uncle Sam is not getting it. Even his granddaughters, Paris and Nikki, are not getting it. The 80-year-old family patriarch is giving almost all of it to the Hilton Foundation, one of the largest philanthropic organizations in America. What does that say about what he thinks about his own family and his country's government? I'm joined, of course, by our panel, Jonathan Honig, John Layfield, Tracy Burns, and Peter Schiff. Jonathan, what do you read into this?
Well, I think bravo for Barron. His family worked hard to create this wealth, and frankly, Stuart, I'd have rather seen Paris and Nikki get it than the federal government. I think they probably could have been more productive with it than the federal government. But certainly the fact that it's going to the foundation, which will do great charitable works, that's the best answer of all, and certainly it's better that the foundation have it than Uncle Sam.
Tracy,
so bravo, Barron.
Tracy, do you think he should have given it to the government when he dies? Just give it in estate taxes?
No, absolutely not. This family worked really hard for this money. I applaud him for not giving it to his granddaughters, quite frankly, because they have gotten in enough trouble with the money they already have. And truthfully, they're claiming that they're making their own now, so let them. I think he's done the right thing with this money.
Well, he didn't have to pay estate taxes. At that level, billionaires is voluntary.
Yes, but the way he's doing it now, truthfully, he's wiping his tax bill out altogether, quite frankly. And the money will be spent in much, much better ways than Paris and Nikki prancing around town with it.
John Layfield, will you stand up for a large inheritance for Paris or Nikki?
I can just imagine how many sex tapes Paris would come out with that type of money. I think it'd be amazing. Look, I don't blame him. I wouldn't give it to Paris. I wouldn't give it to the government. Tracy and Jonathan are dead on. This money was taxed 2 or 3 times by the time he ends up being put in the ground. Why give it to this inept government to study cow flatulence, how it affects global warming? He is right. He made this money. He earned it. Make sure it goes to where you want. I just don't like the hypocrisy of billionaires who don't pay it anyway, arguing for the estate tax.
Oh, I'm with you all the way, John. But let me ask Peter Schiff. If the economy is crashing, America is bankrupt, I presume you think that Mr. Hilton should have given this money to the government to bail out the government. Am I right?
No, under no circumstances should the money go to the government. It's much better if it's going to go to charity that it be a private charity. But, the larger issue, it's unfortunate that so much of these fortunes are being given away, even if they go to worthy causes in the short run, because in the long run, society would be much better served if these fortunes were left intact and productively invested in capital investment, in starting new businesses that would provide low-cost consumer goods and employment for people for generations to come, not simply, some money right now.
The heart of this issue is death taxes, the estate taxes. Should we keep the estate taxes?
It should be abolished.
Anybody on this panel who supports death taxes? Anybody?
Well,
Stuart, any takers?
Stuart, it's huge amounts of money like these and mega billionaires like these exactly who politicians like Hillary Clinton feel as if have an obligation to give their fortunes back to public at large. And it's fortunes like these that specifically these politicians are arguing should give their money back to the government. So
yes, but it's these billionaires who insist that we should keep estate taxes and that the money should go to the government. It's the Warren Buffetts of this world. Tracy?
But the thing is, the reason with the estate tax intact, charitable donations will be made. Once the estate tax goes, there'll be no incentive to give to charity anymore. So that could be part of the reason why these wealthy people want this estate tax around, so that they can continue their charitable giving.
There was charitable giving before the estate taxes came around.
It would be sliced in half, and the numbers are there to prove it, that if the estate tax goes, there's no incentive to give to charity.
And as Bradshaw said, you're going to see billions of dollars poured into ethanol and farm subsidies and libraries and all this other nonsense instead of actually going to a productive purpose.
May I suggest, for one brief and shining moment, that the money should have gone to Paris and Nikki. They seem to be quite... No, I'm serious here. After all, they are family members. They, I don't necessarily they deserve it, but they are productive in their lines of business, shall we say. What's wrong with them getting the money?
Well, I don't know. I'm sure they just would have consumed it. What increases society's wealth is not when billionaires consume their wealth, but when they make it available to the rest of the world through investments in productive assets.
John Layfield, what's your point of view?
I think we're missing the point here. Look, Mr. Hilton made this money. He should be allowed to spend it however he wants. The hypocrisy I don't like is these guys pay capital gain rates. They say we should they should raise the tax rate. They don't pay death tax. They say we should keep it intact. But the fact of the matter is, Mr. Hilton made this money. He should be able to give it to Paris. He should be able to give it to whoever he wants to. It is his right in this free world to make this money and give it wherever he wants.
Well, no one disagrees with that.
Ladies and gentlemen, we have reached consensus. Paris should not get it. The government shouldn't get it. The gentleman should do what he likes. We're in agreement. That's pretty good.
Yep.
One and all. Thank you. Apple shares soaring to new highs today. Here with that and the other stories we missed are Jonathan Hoenig, John Layfield, Tracy Burns, and Peter Schiff. Jonathan, what about Apple?
Well, amazing stock, Stuart. I mean, this Apple computer was a $3 stock 10 years ago, but today it traded over $200 a share for the first time. I mean, this stock has just been absolutely on fire. It's up over 130% this year, but I think a lot of what's going on is this end-of-year window dressing. I mean, you've looked like a genius if you've owned Apple, and I think a lot of the portfolio managers are buying it right now just to kind of have it on their books at the end of the year so they can say, oh, yeah, we owned Apple Computer, because the stock has really been one of the few major winners this year.
It really worries me, the idea of actually buying it at $200 a share, because it's got a kind of a dot-com feel all about it from 1999, don't you think?
Yeah. But then again, you just bought a computer, right? So you're kind of late to the computer craze in general.
Thank you for reminding our viewers that I only got my first computer period about 6 months ago. Thank you, Jonathan. We got a lot of emails on that one.
Full disclosure. But the stock has been quite strong, and I do think there's a lot of window dressing going on, but I wouldn't fight it moving into 2008 either.
All right, fair enough, Jonathan. Appreciate it. How about you, Tracy? What's with this about Toyota?
Toyota came out today and said they were on pace to be the #1 automaker, basically taking over GM's hot spot. The problem, though, is they set expectations very high for themselves. In order to get that top spot, they'll have to retain, their 15% sales share here in the U.S. And we all know U.S. auto sales are lagging desperately. They're going to have to gain share in China. And right now, GM and Volkswagen pretty much have the bulk of the shares of the sales in China right now. So they're going to have to overtake them. Plus, they have their home sales in Japan. The economy is struggling. Not to mention Nissan and Honda are holding their own. So there's a lot of obstacles for Toyota to pass before they can become #1.
That's not like Toyota. They don't set goals that are very difficult to hit. They don't do that.
Agreed.
Why this time?
I don't know. Clearly there's this whole, and it helped the stock tremendously, this whole notion of being #1 and pretty much taking our auto dealers out of the picture.
Did it help the stock?
Sure did.
How much?
Not a lot.
But it went up.
But it went up.
And it's at not a high, but it's way up there, is it?
It's up there.
And you sound skeptical. You don't think they can do it?
I'm very skeptical. I am. Those are 3 big bullet points they have to meet. That's a big checklist.
Would you buy General Motors because you think Toyota can't be #1?
No.
All right, let's move on. Peter Schiff, what did we miss today?
Well, I think the big story was in the soybean pits. I mean, look at soybean prices. They're over $12 a bushel. This is a 34-year high. We're going to have beans in the teens probably within the first couple of weeks of the new year, and they might not stay in the teens. They could go higher than that. And soybeans are very inflation-sensitive commodity, and I think this is an indication that this problem is going to get a lot worse. People are ignoring how bad inflation is, but you can really see what's going on. If you look in these ag pits, also, oil was up $2 today, gold was up $15. Commodity prices are on the rise because inflation is out of control.
We are heading for depression, are we not? And of course, we missed that one today, but I'm still with you, Peter. Go ahead. Answer my point. Go ahead.
Well, I mean, it's going to be an inflationary recession because we're going to have both. You know, you remember the 1970s, Stuart.
Yes,
except
I do.
It's just going to be a lot worse. We're going to have higher inflation and a worse economy. We're just in bigger financial trouble. We've created much more money in this decade than they did in the 1960s. We have bigger imbalances, and so we have a bigger price to pay for all that.
All right, John Layfield, is there anything positive that we missed today?
It's Chicken Little being played by Peter Schiff. The sky is falling. No, look, Jonathan's right about Apple. It is window dressing right now, but you still have 10 million iPods sold. You have 6 out of 10 consumers estimate to buy gift cards. 10% more cash on balance sheets for consumers year over year. You're going to see a January pop in retail. The consumer is going to keep this thing afloat. I don't see us heading into recession based upon the American consumer.
But you know, John, that's very interesting, because we did have someone on the Fox Business Network earlier who said, look, this is a new paradigm in retailing because of gift cards. It's spread out the entire retailing season and given you a shot in the arm in January, which we didn't have last year. Has it really changed things that much?
I think it has changed, but not that much that it's a complete new paradigm. I think you are seeing the shift change. Look, Peter is definitely right about housing. He's right about inflation. But the one thing the consumer is, they haven't lost their jobs completely. This consumer still has the ability to keep us out of recession if they are willing to spend. They're like banks right now. They've got money, but they're not spending it. We are seeing a slowing. I don't think that says we're in a recession.
Yeah. But remember, by spending money, all they're doing is...
Hang on, but to John's point, they're spending money on just different things. Activision,
That's right.
The company that makes video games, I hit an all-time high today. People were out in full force buying those kinds of things. Best Buy did very well this season. Why we're buying tech? Maybe we don't need sweaters.
Remember,
Maybe we don't want to buy
spending,
sweaters.
all this spending is going to make the recession
I've got
worse.
to tell you, Peter, we are not going to go back to being a primarily manufacturing society. It ain't going to happen.
Well, then we're not going to be able to buy anything because no one's going to sell to us. We can't consume if we don't produce. That's just how economics work. All this spending is going to make the recession worse. We're borrowing money from abroad to buy imported products.
Ladies and gentlemen, we are almost out of time.